Hi everyone, welcome to our second lot of our strategy discussions. Today we're going to be chatting about, investment properties, how they work, where they're advantageous, where they don't work, and then similarly how that compares to investing via a share portfolio. I guess first things first, what we do want to say is this is not specific advice, this is general advice, and we therefore disclaim everything that we're about to go through. Not necessarily, but I think the key takeout there is really this is about making sure that you get specific advice, because what we're going to go through here is based on a set of assumptions, and those set of assumptions are one thing we can guarantee they won't come true. So I guess that's what I wanted to get out early.
I think with all of these, Cam, that clients, I think the key part of these updates for clients is highlighting areas that might be key discussion points with clients for everyone, just for information purposes, rather than this is what we think is a good strategy for you type deal. Yeah,
that's right. Spot on. So what do we think, everyone? Shares or property? Which one's better? The age-old question. How many times have we been asked that as financial advisors?
I lost count. Very common. One of the top questions we got asked.
I had a text from my eldest sister last week saying, "Oh, all the management team are sitting in a room at the moment debating about what's better, shares or property. Can you can you send me the data you have?" And I was like, "Oh, funnily enough, we're doing a discussion on this next week, but I don't have the data to hand right now."
Send through the webinar.
Yeah, exactly.
It's especially topical at the moment, isn't it? With all the talk about interest rates rising and what that's going to do to property. And we always say that we don't have that crystal ball. We can't predict the future, but yeah, it's obviously a very topical point of discussion right at the moment. So timely, I guess, this strategic update.
Yeah. Just as an addendum or an aside, as I was travelling in this morning, and then you can clearly see I then turned around and came home because of my youngest has got COVID. Anyway, as I was travelling in this morning, it became apparent that over the weekend, our leader of the country, Scott Morrison, and the coalition government is essentially saying, "You re-elect us, and we will make sure that you can access the money in your super, if you haven't bought a house yet, to buy a house, to help you fund a house." Now that's going to create, that puts the cat amongst the pigeons a little bit, because that's, what does that create? What do you think?
All right, jump in. Anyone else?
Well, I guess, does that then sort of promote, does that have the opposite effect to property prices for first-home buyers? Does it make them sort of be priced out even further? Do they get assistance from parents? Greater financial assistance from parents to help them get in. So I don't know. Does it create more of a on property prices potentially? I guess, and that's on the property side. But equally, does it erode? Obviously, it erodes their superannuation balances. So what kind of counter impact does that have for their long-term future? Yeah, so risky strategy, I would have thought, but you hope they know what they're doing.
I think the potential is it's a subsidy, right? So you add a subsidy into a market, and then subsequently what subsequently happens, ceteris paribus, everything else being equal, is the value of that market goes up correspondingly.
We've got a perfect example of that happened with the first homeowners grant, just after financial crisis. Like, I happen to be one of those beneficiaries, but I got given 32 grand by the government to buy my first house, but you know what happened? House prices went up within 6 months by more than what the government grant was.
Yeah,
that is exactly what will happen again. Why wouldn't
So-
it? It's just market
So,
dynamic.
so get in early, right?
Well,
Do
yeah,
like the best.
essentially. Yeah, but but then you've put on you've been given, as you've already said, Cam, you've been given that amount of money, the market goes up. It doesn't improve affordability at all because prices have just gone up. You've supported, and because, well, as I've read already this morning, there isn't anything to deal with, at least that I've heard of, with the supply side aspect of this equation. But as Andrew's already pointed out, well then, or all of a sudden, you've got up to $50,000 worth of less in your super fund compounding year on year on year.
Yeah. So what's really interesting, both politically and economically, is what the government has said with this proposal is they will actually make you put that money back into super when you sell your first home, right? Plus, and the growth. They also talk about the growth. So, if you buy a place worth $500,000 and then you sell it in 10 years' time for $1 million, because property only ever goes up, and we'll talk about that, then you're actually putting $100,000 back into your super fund because you're putting all the growth you've got on it back as well. They didn't talk about losses. What was that, Louisa? Sorry?
So then you're kind of back to square one when you sell your house.
Yeah, but I suppose you're now in the market, aren't you? So you've gone from not being able to get into the market to now you've got a place worth $1 million, but you've got to give 100 of that back and put it back into your super fund. I'm just thinking about all the strategies we can use around that. But anyway, this is just a proposal, and of course the coalition government has to be re-elected in a week's time for this to actually. But it is funny that it comes out a week before the election.
Yeah, there's a whole lot of discussions about people using contribution caps to tax effectively then put money in to take out, and those types of strategies that happened during COVID with the JobKeeper stuff that the government then tried to unwind, which that hasn't necessarily been explored. So it there's, as Cam's just rightly pointed out, we have to wait until Saturday to find out. But if the coalition get back in, well, there's going to be some interesting times in this space.
So just back to while we're here, let's maybe talk through the benefits of buying an investment property. Who wants to talk us through some of that? I can.
I'll jump in.
All right.
It's very clear, yeah.
So benefit of buying an investment property primarily, I think, is the what we call the amplification of the return, right?
Yeah.
So the example I always use is you go buy $1 million investment property, and you borrow $1 million to do it. Now let's say that you rent that out, and maybe you get let's call it $30,000 a year. Interest rates at the moment on investment property, let's call it 4%. It's probably a bit high, but anyway, works for my math. So therefore, your $1 million at 4% is costing you $40,000 a year in interest, but you're getting 30 a year back in. Now, there's probably also some additional costs, maybe some home maintenance, maybe some paying body corporate fees or rates or whatever it is. So let's add in, I don't know, another 10 there. So we get to $50,000 in costs. So we've got 30 coming in, we've got 50 going out. Therefore, it's cost us $20,000 out of our cash flow to buy that property. So you've got $1 million property, and it's only costing you $20,000. Bearing in mind no principal repayments, because it can make it a bit more complex. So the cost to you is $20,000 a year. Now, if that property goes up by 10%, then what we see happens to the value of that $1 million, the value of that property is in 1 year's time, that's worth $1.1 million, right? So it's cost you $20,000 to make $100,000. So that's a 500% return. That sounds pretty good. I'll have some of that, thanks.
Okay.
But there is also a downside, and the downside is, what if it's a -10? Okay, so the -10 is you've got your $1 million and property prices fall by 10%. then actually the value of that property is 900 now, not $1 million. So it's cost you 20 and you've lost 100. So now you're down 120,000. So that's minus 600, right? Minus 600% return. I don't really want that. Is that right, Chris? I can see you doing the math.
Yeah, no, I think it's the same on the way down as the way up.
Yeah,
so 500,
yeah, it must be. Yeah, okay. So let's call it minus 500. And this is why we've put the disclaimers up front, because we're doing this off the top of our heads.
Yep.
So there's a real variability in the returns. And then often, Lynn, Louisa, Andrew, as you know, we often get asked, well, which one's better, and shares or property? And so on the other side of the coin, you can take your $20,000 and you can go and invest it and get that same 10% return. So your $20,000 invested has given you a 10% return. And that means at the end of 12 months, you've got $22,000. So you've made $2,000 versus in the first example, you've made $100,000. So I would rather make 100 than make 2. It's a really significant difference. It also works on the downside as well, right? So you get a minus $2,000 versus a minus $100,000.
Yeah.
So we have this discussion with clients all the time, I think, where we're chatting through what is the best option and how does it all work? I think you just need to be aware that when you buy property, that the reason we typically see properties doing so well is primarily because of the amplification of the return over time. That's why it's the gearing. So banks will end up to 95%, sometimes 100% if you've got another property to leverage against. Yeah. So the amplification of the return is why it works, because the return numbers, and Lynn, I know you've done a bit of research, on what the return numbers are. The return numbers in property over the last 40 years has been 9% growth rate, whereas shares it was, what was it, guys? I can't remember now.
9.7.
9.7, right? So the returns are about the same, of about the same. So I think, so that's maybe part of what the issue can be, right? Is that you can get a positive return out of properties, and typically in the past, that's what we've seen. And I know there's actually a slide here that I might show you, and this shows you property price growth since 2004. That's just one simple line. It's generally an upward trend, right?
Yep.
That's generally what we've seen. Now, there have been periods post the GFC, so it fell, was it about 10%, Chris, 15%?
Yeah, I think so. Your mic's just dropping in and out, Cam, so if you can lean in a bit, that'll pick you up.
But my face will be a lot bigger then.
That's okay. People love your face, it's fine.
I'm not sure that's right. But yeah, so I guess that's it's interesting that we've seen property price growth. Now the question then becomes, well, does it continue? What do you think? Does it continue?
Oh, who knows? I mean, you would look at that sort of chart of 18 years or so, and in particular the last couple of years, that really steep climb. And there's probably been periods of about 4 periods over that 18-year history, 3 or 4 periods where there's been a flattening and a slight dip. So I guess you would, now we don't know what's going to play out, of course, and in 3 or 4 years' time we could look back and see, the benefit of hindsight and see what actually has happened. You would think that, and based on the interest rates increasing, we'll see there's a slide sort of coming up which shows a bit of correlation, but you'd expect potentially for there to be a bit of a flattening out, but whether there's an actual decline or not, who knows? Yeah, I guess it depends on how steep they go with rates and how fast, and that'll certainly have an impact.
That's actually a really good point you bring up around interest rates. Right, Chris, I
was just going to say, if you're a believer in statistical mean reversion, it would. Because that period from 2020 up has to revert at some point if you were to draw a trend line through that graph. So anyway, whether you want to follow that or not.
We'll get you to explain that at a later Shoot, Chris.
Let's just have a look at interest rates, because you raise a good point around interest rates. This is Australian residential property prices, and this is broad, right? So it's across Australia. It's not a specific subset of Melbourne. It's not Melbourne. It's properties across Australia versus the overdraft lending rate, which is, you know, higher than bank home loan rates. Very, very much higher. But it's the only one I could get. And so what you can see here is over time, you know, there's almost an inverse correlation, I reckon, there. So over time, as interest rates come down, property prices continue to rise. It's not, I'm not sure how tight it is, but that's been, in my mind, that's been one of the things that's driven property prices in the last couple of years, has been interest rates essentially halved. Because we had interest rates at pre-COVID, what were they, about 4? Home loan rates, about 4.5?
Yeah, 4+, yeah.
And as you know, some clients managed to lock in fixed rates of 1.89 over 3 years, so call it 2%. So you've seen interest rates halve. So what that does is that reduces repayments significantly, halves interest repayments, not necessarily principal.
Makes sense though, because then you end up with more in your pocket. So then you've got more, when the bank's reassessing you for another loan, you've got more surplus income in order to borrow more.
Yep.
You can borrow more, then you can go and put your hand up higher for a higher amount.
Yeah.
The interesting part that I found about this chart was that, like, if you look at the sensitivity during periods of interest rates falling, property rates went up significantly faster than the converse, where interest rates were rising. The softening of house pricing was actually significantly less. So if you're looking at the sensitivity of behavior between when interest rates were going up and interest rates were going down over this period, speaks heavily to our cultural biases here in Australia and our behavioural biases about how we view property and what we think will happen. And I think that this is like a big underlying factor of part of this discussion, is that we're trying to look through and take out, I guess, some of the, in our everyday interactions with clients, we're trying to minimise the behavioural biases that people bring with them. You know, the property is probably the one thing where we all exhibit the biggest amount of behavioural biases towards.
That's a really good pickup. It's very interesting. I just wonder, I mean, anecdotally, when we speak to clients about, when clients speak to us about, so the property prices, our property prices have come off, they've fallen. We'll just wait till it picks up again.
Yep.
Is really always the response.
Yep.
And for the most part, most of our clients with respect to equities would say the same thing as well. But I guess the distinction is, unless you're a forced seller of your property, it's generally how people approach it.
Yep.
Now the problem becomes when you are a forced seller, sorry. So if you have to sell because the bank is making you sell because you can't make your home loan repayments.
Yep.
And we haven't, I mean, when was that? That was the early 90s, right? When unemployment spiked, interest rates went up significantly. There were forced sellers in the market in Australia. But also, if you look at the US property market, that happened post-2008, right? It was foreclosures. Oh, it's gone dark, Andrew.
I was too still.
That happened post-2008.
Yeah.
So,
interestingly, Cam, if you go back to that chart of the property prices, is the 90s included in that?
no. 2004.
Yeah, interesting.
Yeah, I couldn't
What
get
about
it.
the next one? Does that pick up the interest rates versus property prices? No, it doesn't. Well, I guess you pick up some of that drop, right? Or that's an interest rate drop rather than a property price drop. Yeah. Okay.
The other thing too, I think, is, and this came up obviously in the lead up to the recent increase in interest rates, but in recent history, we've just come off the longest period of time without an interest rate increase.
Yeah.
Right. So, you know, I think they said there's about a million mortgage holders in the last 12 years that have never experienced an interest rate increase. So I guess the coming up, that's going to be an interesting period of time as to, again, as I was saying earlier, how aggressive rates go up and how quickly, etc., and what the impact that'll have on people that potentially may have been stretching themselves in the past. And I guess it might trigger, if people are highly leveraged, it might trigger some sort of sell-off, which I guess goes to the point you were talking about there, Cam.
Interesting though, isn't it? Because when there's been sell-offs in the past, if you have a look at this chart, actually it was this one here, wasn't it? When interest rates have gone up in the past, to Chris's point, they sort of, it doesn't really draw back.
No.
Significantly, right? People will just hold, they'll just won't sell. But again, we just haven't seen that forced selling that occurred in the UK and occurred in the US and most of Western developed economies post GFC. We didn't see that in Australia. So
it's interesting because I do wonder this sometimes about like the psychology, whether the psychology of property here in Australia is any different globally. Like obviously, you know, we've got our own environmental biases, but I feel like it's very strong here in Australia that you know, that buy property, hold property, don't ever sell it, it'll be fine mentality.
Yeah. Which also in the past has made it a really good asset class to own.
Yeah. Yep.
One of the other things I was going to mention before is we've been in the midst of a renovation for the last couple of years in our place, and the costs of renovating just continue to go up. So I wish we had actually done it properly 3 years ago. But anyway, this chart, this property price growth chart, does not include what it costs to renovate homes. So when we talk about the 9% growth rate that we've seen in property, or 8.9, whatever it is, over the course of the last 40 years, this home that we bought was built in 78, and it needs to be fitted out again, right? It's falling apart. It was falling apart. So we've got to put more money back into it. And that annual growth rate does not include the cost of redoing the house.
Yes, that's another point. Like when we talk about return of property and shares, we often overlook the expenses of buying, selling properties and holding it. I think that's one major factor we need to consider. What's the cost involved? Yeah.
Yeah. And I think that is often not included because you know, I bought a home I'm making this up, but this is what we'll hear all the time. I bought a place for $300,000 and I sold it 20 years later for $1.5 million, but I've renovated it twice in the meantime. The first one cost me $200 and the second one cost me $700.
Yep.
So, you know, I'm not saying that that's taken all of the return away, but, you know,
there's an element.
It's certainly a factor. You just can't find information on it. And when we were putting these slides together, that's when I went looking for.
Yep.
But I couldn't find it.
I think that's one of the key, takeaways that I suppose we want people to get from this is that, you know, the key takeaway is there isn't necessarily one that's better than the other. It's about what works best for your scenario, right? And then you can't just do the mental arithmetic and say, well, I bought it this and sold it this, but you paid stamp duty when you bought it, you paid capital gains tax when you sold it, you renovated twice, you had all the interest costs along the way. It's not as simple.
Another major factor we haven't talked about is diversification. Like when we talk about return, another question we need to ask is how likely we're going to get that return, because the return we're using is the market return, is the average. When we say 9% share market return, if we're investing ETFs or like a passive investment style, we're very likely to get a market return. But if you're buying one single investment property, how likely are you going to get this investment return, average investment return of the property market? There's a chance you may exceed it largely, good for you, but there's also a good chance that you may not reach the market return. Like if you're just putting all your money into one single investment property. So that adds lots of pressure on the investor to really do their research, really be careful, make sure they're buying the right property, like not assuming all the property will just grow at this average rate. So
speak to those people who bought in the mining boom in the mining towns.
yes,
I'll have
exactly.
some stories for you.
Like for example, for myself, like I'm not a property expert, but I watch the area I live in very carefully. Like the suburb I'm living in, I check all the properties that have been sold in the past 3 years, like almost every week. And my overall impression is, regardless what's the market, like what's the news saying, the property has gone up 5%, 10%, or it has gone down by 5%. My overall impression is there's always good deals, good buys, good sales, and the bad ones, especially when it comes to auctions. Every now and then I have an impression, oh my God, this property gets sold for that price. Are you kidding me? And then 2 weeks later, I was like, oh, those guys got a really good deal. So it really depends. So what's this on the news? And when they talk about the overall property return, maybe not as relevant as when you actually at the auction and or the specific investment property you're looking at. So I guess that's another tip. People may get too emotional when they buy that's another behavioral bias, like probably we just covered earlier.
Absolutely.
You need to be careful. Yeah.
So I think, as Chris was saying, it's really, really important to get specific advice around your personal situation, and that will help. Certainly, if we go through the process of working out, well, yes, you can afford to buy a property, and yes, it will mean this for you and your life and the life that you want to live with purpose, then that might be the right thing for you. Conversely, shares might be the same sort of thing. No one in this virtual room can tell you what your return is going to be on properties or shares over the course of the next 1 year, 3 years, 5 years, 10 years, because we don't know. And I think it's important to state. And so specific advice around what you can afford, how the cash flows work, whether that works effectively or not for you is what's most important. Not trying to pick this market will give me the best return or this market will give me the best return, because we don't know. There's a question mark. There's no crystal balls in this virtual office. All right. Look, I think that probably wraps us up, everyone.
May I say, yeah, this is probably just the surface. There's so many details we haven't get into, but it's a very good discussion. Like, for example, I think we have it in the slides, like positive gearing, negative gearing, because some people, they do invest in property for passive income, and also the tax benefits. I think one of the common questions some clients may raise is, oh, I really want to reduce my taxable income, so I want to buy investment property to reduce tax. I think we'll have something to say about that as well.
Yeah.
Probably that's another.
I need to say about that then. Probably, maybe it's a discussion for another day. I think one of the things that, if we're going to wrap this up, is it'd be interesting to get those of you who are out there listening to that to get some feedback from you, because we probably had another whole big branch of area that we wanted to really cover here and I guess make a direct comparison against, but time is always an enemy. Yeah, some feedback to see whether how deep down the rabbit hole do you want to go? What other topics do you want to explore? It'd be really interesting, because I think we see this as an iterative process with you all. So I think it's important to continue to have these conversations, and you're all part of that conversation. So we'd love to hear back from you all, and keep churning these out, I suppose, with some more tailored content.
You're doing the monthly.
Yeah.
Any suggestions are welcome.
Definitely.
All right. Thanks very much, everyone. That was great.
Thanks all.
Just touch the service, but we'll talk to you soon.
See you.
Bye.
Happy voting.
Bye.
Happy voting. Exactly.